Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 2, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. We've got a lot of stuff to cover tonight. I'm going to go through a lot of different things. We had a tremendous down day in the market today. The S&P or the SPY was down over 2%. The Dow was down about 2%, slightly less. The NASDAQ got killed, almost 3% down, 2.75%. So everything was down across the board. There's a lot of stuff going on, and there's a lot of things being discussed in the media that may or may not be true, but we're going to cover a lot of this stuff tonight. So first things first. Underneath this video, go ahead and leave some comments. We can get a discussion going about what you think about the markets. I'll respond what I think about the markets, ask me questions, whatever you want. I like to get some comments on the videos. It's a lot of fun. Like the video if you like it, dislike it if you don't like it, whatever your fancy, that's fine. And go ahead and share it with your friends because I think these videos can be helpful to a lot of people just to add some clarity to where the markets are headed. So let's go to the SPY. So we're looking at a daily, and we talked about the fact, and I'm just going to do a little bit of a recap. We talked about the fact that the Spider or the S&P 500 was consolidating above the 200 period moving average. We kept testing in and around the 200 period moving average. And the more times you come close or test the 200 period moving average, or any moving average for that matter, it definitely diminishes the importance of that moving average or of a specific trend line, of a support area. So in this case, and we looked back a couple of different times, that the S&P futures had really tested the 200 period moving average more than the cash S&P index or the Spider because we have an overnight session in the S&P futures market and there was an extra test of the 200 period moving average. Just go and show you real quick. So way back in February, we had two hits of the 200, and then you can see us consolidating above the 200. And you know what I say all the time, over and over again, when we consolidate in a fashion like we just did, we have a down move, and then we go sideways for a while in a wedge formation. That's the market's way of indicating that there's another move coming in the downward direction or a continuation move. And that's what we began to see today. So a couple of things that are also important to note on the Spider chart. We closed below this low here. The low from the 23rd of March came in at 257.83. We closed below that low today. So now we made a new recent low in the SPY. I think that's important. The next area of support, there's really two, but there's one that comes in right down here, this double bottom. We're not that far away. And then you have that 250.32 area that we've been talking about for quite some time. I'm still going to stand by the fact that I don't think the selling is over just yet. I don't think we have a bottom in today. Even though we had a nice rally off the lows from today, I don't think a bottom is in. A close below the low right here from the 23rd of March, that's a negative. A close below the 200 period moving average, that's a negative. Not to say we won't have a bounce higher for a day or two. That's certainly possible. However, this is not the signs of a low being put in. Generally speaking, if we finished on the lows today, I might feel slightly differently. If we gap down and have a reversal intraday, I might feel differently. None of those two things happened today. In fact, the market really didn't open that much down today. The market opened slightly lower, and then we trended lower all day long. And while we had nice volume today for a down day, 184, almost 185 million shares in the Spider, it's not capitulation volume. This is capitulation volume. That's what we're really looking for. We also don't have a signal of a low being in place from a trend change signal or a reversal candle, nothing like that. So my take is, at least the way I look at the markets and from what I can tell, I don't see a low in this market just yet. Now remember last Thursday we had that decent up day, but we didn't finish as strong as the day really was. We kind of sold off the last half hour of the day. I think that was a tell of what was coming today. Of course, you couldn't necessarily know that in advance the way today's market was going to trade. However, looking back, playing Monday morning quarterback for a second, I think that was an indicator. But what we did say was that as long as the market stayed below the 266.50 or did not close above the 266.50, it didn't matter how high it went. As long as we were below that level, this was still a bearish pattern that was prone to more downside activity. I'm going to leave the 266.50 in there for now. We didn't need the other line, the other resistance line. It's not important right now. Another thing I want to discuss is, and if you're watching television or looking at the blogs today, the internet, there's a lot of different things being discussed in terms of the news. Everybody always wants to know, and I get flooded with emails, and I don't mind the emails at all. I get flooded, why is the market down? It doesn't matter that it's down. It was the chart that's telling us the direction of the market. The chart was in a bearish pattern. That says, at least to me, in the way I view and analyze the markets, that the market was building energy for another move lower. That's exactly what began to happen today. It did happen today. And the news kind of comes after the fact. Let me explain a couple of things. So if you look around the different blogs or you watch television today, you're going to hear a number of different reasons why the market was down. You're going to hear trade wars, China imposing tariffs on us imposing tariffs on China, imposing other tariffs on other countries around the world. So you're going to hear trade wars. That's one of the reasons for the market being down according to the media. You're going to hear Amazon. You're going to hear how President Trump is all over Amazon and Amazon's selling off, and that's a reason for the market to be down because the tech sector is being dragged down by Amazon. That's another reason the media purports the market being down. I even saw one headline today suggesting that the reason the market was down was because of Bitcoin, and that was by a pretty well-respected fund manager, Jeffrey Gundlach from Double Line Management. So I was a little surprised to see that. And truth be told, I really didn't read the article, so maybe the article says something different, but that seems a little bit preposterous to me. Doesn't really matter. Those aren't the reasons the market is down. The market is down because we entered into a down cycle in the market. The cycle is playing out. Sooner than later, the cycle will at least take a pause. We will hit a specific number. The market will put in a reversal and we'll trade up for 3, 4, 5, 6 weeks. And then we'll see what happens from there. Maybe that number is 250 in the spider. Maybe it's 249. Maybe it's 251. Wherever that becomes, and we're not just buying 250, right? I just need everybody to be aware of that. You don't just buy an arbitrary number. You wait for signals of a reversal in the market. We're waiting for signs of a trend change. All the things that are discussed in detail in the course at Lazy E Mini Trader, we talk about the signals of a trend change. We talk about what a market reversal looks like, an intraday reversal, and there's other definitely distinct and obvious signals of a trend change. That's what we're waiting for. We don't have to be the first one on the bandwagon. We don't ever have to be the first one to the party. We just need to be at the party while everybody else is having fun. And so therefore, we don't have to pick the low to the penny. We just have to recognize that a low is in, and then at least we have something to trade against. We know where we would be wrong if the market continued lower, and therefore, we're able to make a wise risk-reward trade. That's what we're looking to do. So before we move on to the other markets, there's a couple of other things that I want to discuss. I think they're just interesting items, and they get a lot of headline news, so I thought I would bring them up today. The first one is Tesla. We get a lot of news-related items around Tesla. They've had trouble with self-driving car, they've had production issues, this, that, and the other thing, but that's not really the reason why the market is down, or Tesla is down, I should say. Those things have existed in the past, and the stock has been up, so therefore the market tends, when the stock is up, to shrug off those kind of items. I think, and this is my opinion based on what I can see, I think Tesla's down because I think they're in somewhat of financial straits. Here's the deal. So Tesla, they still have analysts with price targets on Tesla at $3.25, $3.50, who knows? There are all kinds of price targets. The reality is this chart looks ugly from a daily perspective. On a weekly, it doesn't look much better. We're into the 200-week moving average, so you may find some temporary support here. Maybe we go sideways, maybe we bounce off this level. But what I see happening in Tesla is a couple of things. Number one is, obviously, or maybe it's not obvious, but it should be, they don't make any money. They lose about $11 or $12 a share. That's on the last count from last quarter. So that's item number one. But that's not really the issue. The issue is that they're going to have to raise money. In the past, when Tesla raised money, they issued some bonds. And here's the problem. Their bonds are trading at poor levels right now. Last I checked, and this was at one point last week, I think I saw some of their bonds at 83 cents on the dollar or 85 cents on the dollar. That's at a price level where they're not going to be able to issue new debt. They're really already in junk status, and they're not going to be able to issue new bonds. The cost of money to them in junk status at that price level is way too high. They can't really service that debt because they certainly don't have the cash flow. They lose money. So the bond market's not going to let that happen. So the second thing they have to do, or the alternative to issuing bonds, because they do have to raise money, the alternative to that is to issue more stock. So if they have to issue equity, they're diluting all the other shareholders. That's what the stock market is telling us is going to happen right now. So at any point in time, don't be surprised to see Tesla come out with an announcement that they're issuing stock to raise money. That's going to hit the stock. The stock's going to go down on that news because all the existing shareholders are going to be left holding the bag. They're going to be diluted as a result of the new issue of new shares. Just thought it was interesting for those of you that are Tesla watchers. Nothing against the product. I think the product is phenomenal. I think Elon Musk is phenomenal. I think he's doing great things with some of the other companies he runs. I have nothing against Tesla or Elon Musk. I'm just looking at the stock, I'm looking at the bonds, and I'm looking at the chart. That's it. Nothing more, nothing less. The other stock I wanted to make mention of today is Amazon. Amazon's in the news every single day. President Trump is hammering Amazon. Tax issues, lobbying issues, Bezos buying the Washington Post. Trump doesn't like that. I get all that stuff. But the bottom line is that we need to put in perspective where we are relative to where we were. No question, Amazon's taken a huge hit over the last several weeks. But let's put in perspective where we are. The horizontal line running across the screen, $1,169.47. That's where we closed out the year in 2017 on Amazon. We went as high this year as $1,617. The high was $1,617.54. Okay, then we rolled over. That was a reversal day. And then we rolled over, had a little bounce, and we basically collapsed. We're at $1,371.99 on close today. Keep in mind, we're still up 15% for the year. That's item number one. And we were up, I think at the highs, 27% in just, the first month or two of this year. So you have to put in perspective, that's unrealistic. It's unsustainable. The Amazon didn't increase its enterprise value by 27% between January and February of 2018. So the stock was in a melt-up phase. Now we're just coming back down to reality. Still up 15% for the year. Again, nothing against Amazon. Like everybody else, I get Amazon boxes delivered to my house almost every single day. It's a phenomenal company. But companies don't increase by 27% in 6 or 8 weeks unless there's an event or some other financial reason. In this case, it was just a garden variety melt-up. So now we're just coming back down to earth. Still up for the year, 15%. Thought it was just interesting to point that out. One more thing I want to point out. Let's take a look at Deutsche Bank. Now this, as far as I know, is the largest banking institution in Europe. Extremely important to the German economy, extremely important to not only the European banking sector, but also the global banking sector. Look where Deutsche Bank is relative to where it was at the end of January. So at the end of January, this thing's about $20 a share. And now we're at $13.68. That's a nice haircut. But that's not the same as the other banks that we look at on a regular basis, namely some of the ones here in the U.S. How about JPM? And I'm going to come back to Deutsche Bank. So JPM is just a normal garden variety sell-off, putting in a bearish pattern around the 100 period moving average. The chart is telling us it wants to trade lower, but we're not that far off from the all-time highs. The all-time high was 119. We're still at about 108. That's considerably different than Deutsche Bank, okay? We have Bank of America, all right? Same chart as JP Morgan. We also have Goldman Sachs, okay? Very similar chart. These stocks are not down the same magnitude that Deutsche Bank is. But let me go back to Deutsche Bank and I'll show you something even more scary. When I look at the long-term chart, here's a monthly chart of Deutsche Bank. Deutsche Bank is melting away from a long-term perspective. This is the chart's way of telling us that there's big trouble ahead, mainly for Deutsche Bank, but it could populate through Europe, because if Deutsche Bank is as important to Europe as I think they are, that means that other banks are holding their debt. That means that there's impact across the board if Deutsche Bank is really in significant trouble. I'm reminded going back 10 years to Bear Stearns, Lehman Brothers, and some other financial institutions that had a large impact that helped create the financial crisis that we experienced about 10 years ago. I'm not suggesting we're getting into a financial crisis. I'm just suggesting that if the largest bank in Europe is melting away over the long term, is the chart trying to tell us something? It never had the type of rally that JP Morgan or Goldman Sachs or Bank of America had. And my question is, why is that? If I'm looking at a monthly chart of Deutsche Bank, let's go back to JPM and look at a monthly chart there. So JPM on the monthly chart, there's nothing wrong with this chart. This is in an absolute uptrend, no two ways about it. Goldman Sachs, monthly chart, uptrend, no two ways about it. Bank of America, monthly chart, uptrend, no two ways about it. Maybe it has to pull in some more. Maybe it's got to go down to $25 a share, $26 a share. That's not the end of the world, but that doesn't look the same as this. This is melting away. This is telling you there's trouble ahead. Again, this may not manifest itself for months or potentially a year or two to come. I'm just pointing out something from a very long-term perspective that's obvious on the charts to me. All right, let's go back to some of the indexes. We'll go back to a daily chart and we'll look at the IWM. And what we see in the IWM is we came within pennies today of my level that was put on here, this green trend line. 146.95 is where that green trend line is. The low today, 147.18. My take is if the markets continue selling, certainly 146.95 will likely be pierced through, spiked through. Then if it is and we close below that level, then this double bottom could come into play all the way down at 142.50. That's a long way from where we are now. We'll see how that shapes up over the next few days, but certainly 146.95 is important, at least in my work. We came close today, but did not hit it. I think we will hit it eventually. One thing that is important in the IWM is we closed below this green candle. That's important. To me, that's the chart's way of indicating lower prices are coming. That low is 148.40. We closed today at 148.13. That's telling me, even though we rallied back to close above the 200 period or 200-day moving average, that's still telling me that there's trouble ahead. There's lower prices likely coming in the IWM. The IWM was weak all day. The IWM was certainly leading the markets to the downside today, along with the transports. My two favorite market leading indicators were certainly leading the market lower today. If you go to an hourly chart, for example, you can see here that we really didn't bounce till the end of the day. This was just a perpetual sell all day long in the IWM. Last week on Thursday, the IWM on the hourly chart put in a signal of a trend change, and look what happened. The trend changed, and we melted away all day today. It's not only the signal of a trend change that was important, it's where it happened. And this is something that's discussed in detail in the course at Lazy E-mini Trader. You can take a lesson from that because any trader that's taken the course knew that not only was it a signal of a trend change, but we were also trading up into an important resistance area. And it really didn't have much to do with the 50-period moving average. It was something else, and that's important to know, and these are the things that are taught in the course. How about the transports? On low today, the transports were down about 300 points. The low today, I'll move this over, the low today was 10,084. We finished at 10,190. So we were down significantly more. We did rally back, didn't close below the low from last week. But as you can see, we're making and continue to make a bearish pattern. Okay, this pattern has a tendency more often than not to play out as a continuation move with another leg lower. So I'm watching very closely the transports. My second favorite market leading indicator on the downside, or on any side. I shouldn't say downside, on the upside or the downside. In this case, it's the downside. As far as I can see, the buying opportunity is likely to come in around 9,600 in the transports, give or take, in this general zone. Most traders would think that this double bottom would hold. I think the buying opportunity comes in around 9,600. So there's a little bit of a distance down from where we are now. There's still another maybe 600 points on the downside from about where we closed today before I think the buying opportunity in the transports emerges. I put a horizontal line at 96.50. I'm going to leave this on the chart and we'll see what happens over the next several trading sessions. We'll see if the market does continue lower. We'll see where the transports go and where they want to make a low. My take is 96.50, 96.25. In that neighborhood is really where I'm targeting the downside in the transports. Let's flip over to the gold market. Now the gold market, again, very, very whippy market. We were down 3 times last week, and now all of a sudden we had a nice big up day, up about $18 today, back above the moving averages. This isn't tradable. There's no clear direction. There's no clear pattern that we can derive a market direction from this chart from the gold market. Until and unless we see a clear directional pattern that we can make a trade off of where we have something to trade against, meaning we know where we're wrong on the trade. Until and unless that happens, we're just going to be spectators in the gold market. We did discuss the fact that the market was in a range in between here and here. And if we broke either to the upside of that range or to the downside of that range, that was going to be the indicator. We did break to the upside and immediately failed, and now we're making another run to break out of that range to the upside. We'll see if it's sustainable, but it's nothing that I would be willing to risk my capital in at this point in time. Crude oil got taken out behind the woodshed, down over 3% today, over $2 in the price of a barrel of crude oil. You can see where we are. We're into the convergence of the 20 and the 50 period moving average. If this holds, we could still maintain the upward directional bias. However, if this breaks and we close below 62.13, I put a horizontal line on the chart. If we close below 62.13, I think there's trouble ahead. You'll still find some support with the 100 period moving average if we did come down that far. However, I think there's trouble if we close below that level. Ironically enough, there's a trend line working. You can see I just put it in the chart connecting this pivot low and this pivot low, and you can see what happened depending on when we would come into this trend line. It may coincide with that 62.13 area, give or take a little bit. It's the daily close that's important. We can certainly come underneath that intraday, and then as long as we close back above that level, that would be important. But this trend line is also important. But today, everything got thrown out with the bathwater. The baby and the bathwater were certainly thrown out together today. A very interesting down day across the markets. And with that, folks, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.